Hi everyone, happy Monday, and welcome to Vixio's first ever LinkedIn Live. Today, Jimmy and I will be rounding up some of the more interesting and impactful regulatory developments impacting the global payments industry across January 2024. Jimmy, January is always an interesting month. I think comparatively, it's always one of the lowest in terms of new regulatory developments. I mean, in the last month, our horizon scanning tool only showed 107 new regulatory events, whereas the typical monthly average typically is around 200 to 250. Comparatively, when it comes to new regulations coming into effect, it's certainly one of the highest. Now, we know it's new year, new me, new regulations. And our regulatory deadlines calendar for January showed no less than 80 new laws and regulations coming into effect, in addition to 33 consultation response deadlines. So what we're going to do today is we're going to tackle this one region at a time, departing from the UK via Europe, through the Middle East and Africa, onto the Asia Pacific, across to North America, before settling in Latin America. So Jimmy, starting in the UK, what's happened in January that's caught your attention?
Absolutely. So I do agree with you. I think that there seems to be always a lot of implementation deadlines coming up in January and at the start of the year. One thing that I did notice that has been happening in the UK at the moment is a consultation that's come out of the Payment Systems Regulator, PSR, basically looking at variable recurring payments. And on Friday last week, that consultation closed. This was looking at how this payment method can be rolled out. Variable recurring payments, or VRPs, they basically enable a customer to give permission to a third-party provider. These are companies like Tink, TrueLayer, Yapily, to make a series of payments from their bank account at variable amounts and intervals with only one SCA, strong customer authentication. And regulators, I think in the UK, really see this as a way to disrupt the direct debit market, and the CMA 9 banks are mandated to set up VRPs. So some of the traction we've seen so far has been particularly from NatWest and some of the others as well, in terms of the innovations that they're making to enable VRPs. I think that there's ways that we're going to see VRPs really change payments. It's all part of the open banking story. So whether it ends up being a success or not, who knows? But I think that they can really provide a lot of benefits to consumers and also merchants. One of those ways, for example, is reducing the risk of coming into high overdraft fees. Another way that I think it could really benefit companies is through more frictionless subscription payments and also B2B invoicing. So I think that VRPs will definitely continue to be a theme throughout the year. And one thing I'm looking forward to seeing is the responses to that consultation, which should be published quite soon.
And do you think, is that weeks or months away, do you think we'll get to see those consultations?
So it really depends. I think it's likely to see, we're likely to see responses to the consultations come out over the next few months, because there has been a commitment from the PSR and others on the JROC committee, the Joint Regulatory Oversight Committee. For those who don't know, that is the committee in charge of open banking in the UK and what happens next for it. They're really, really keen to push VRP. And I think there's a lot of enthusiasm from the market as well to get this going. There's been talk about it since like 2020, at least from my side of things. So I think it will be interesting to see how quickly the banks, the CMA 9 banks, get on board and start to roll that out.
Yeah, and this touches everyone, doesn't it? Banks, PSPs, open banking providers, merchants. So yeah, really interested to see what comes from that. I also noticed that the PSR launched a consultation just proposing some revisions to directions 14, 15 and 16. I think some background here, they've been working to overcome some of the issues identified in the card acquiring market. These were things like lack of transparency, overpricing, and lengthy contracts. I think it was 16 that limited the length of the initial terms of POS terminal providers. So essentially, it gives merchants a bit more protection. Now, the new consultation looks at adding checkout.com to the list of directed PSPs. The other interesting thing is that it also introduces a new mechanism, which, the way I understand it, means if PSPX is a directed entity and they transfer their business to PSPY, then immediately PSPY becomes a directed entity itself. So that I thought was quite interesting, especially as, you know, maybe 2024 is one of those years of consolidation, rationalization, M&A, who knows. Anyway, we spent enough time in the UK, and I'm in that metaphorically. I love it here. Moving on to the EU. Jimmy, what's caught your eye in the EU in the last month?
So what I'm going to talk about with the EU is all about one company in particular, Apple, because there has been so much that's happened in the last few weeks. This isn't necessarily new regulations, but rather the actions that Apple is taking at the moment to adapt to, one, the Digital Markets Act, and also some of the commitments that they are making to deal with a investigation that was launched a few years ago into competition concerns with their tap to pay or NFC payments. So with the DMA, there was an announcement from Apple about 2 weeks ago, looking at the main changes for developers and payment firms to be aware of for Apple to comply with the DMA, which is this huge piece of regulation that's coming in, basically tackling gatekeepers. It's what I like to think of as the EU's war on big tech. We're seeing that really play out throughout different regulations that are coming in. Those can be regulations that are affecting payments companies, but also regulations that go way beyond that. And the DMA is one of those that will, I think, affect payments, particularly for those big tech players, but will also hopefully enhance competition as well for others in the payments ecosystem. So the main changes for developers and payments firms to be aware of for app distribution, commissions, and payments methods. So for the first time, Apple is going to allow developers to distribute iOS apps via alternative app marketplaces. However, Apple is continuing to argue that this comes with unavoidable privacy and security risks. Apple has also slashed its commission on in-app payments from 30 to 17%, with a further reduction to 10% on in-app payments to qualifying small businesses. So basically, I think this is going to be quite a big change, and app users for the Apple payment processing system, they will need to pay an additional 3% fee per transaction to Apple as well. So yeah, it's going to be a big deal, and Apple has tried to, I think, satisfy the EU's gatekeeper requirements. Whether they do that or not, who knows? I think at the moment there is going to be a bit of a backlash from some of those stakeholders who benefit from the App Store. So one of those, for example, is Spotify, who've already made clear that they're not particularly happy. For example, basically they've said that they don't go far enough and that they're undermining the DMA. And they've particularly taken issue with the download fee, which is basically what Apple will charge iOS apps for each download or update per year over a 1 million threshold. And what they're saying is that it's extortion. So it's going to be interesting to see whether the competition officials at the European Commission agree with that, or whether they think that Apple have actually done enough to be able to satisfy those compliance requirements that are coming in with the DMA.
Was there something about near-field communication that I think it was specifically relevant to the payments piece that really caught my eye in that as well?
Yeah, definitely. So Apple have also made commitments with their near-field communications. So what they so with near-field communications, what has happened, this is slightly separate from a DMA, but there was an investigation into Apple's near-field communication tap to pay that was launched by the competition officials in Brussels or for the European Commission about, I think it was 2020. So it's been going on a while. And 2 years ago, Brussels, the competition officials in the European Commission basically came out and said they did have concerns about whether Apple restricting third-party providers' mobile wallets access to its NFC functionality was anti-competitive. And what has now happened is that Apple has said that it will grant that access. This is a pretty big deal. I think this is the first time this is happening. It shows that the power, I guess, of the European Commission, one of the soft powers that the EU does have, is it does tend to set the regulatory agenda for elsewhere. And what is likely to happen now is that there's going to be more competition, and we're going to see more mobile wallets trying to benefit from the opportunity that that provides. I think that we could see lower pricing for merchants, and also a lot of business opportunities for payment service providers who may want to actually, take advantage of being able to get access to the NFC, which they haven't had before. Now, I do also think that this could grow out of the EU and into other jurisdictions. So the Consumer Financial Protection Bureau in the US actually suggested in September last year that they had concerns about restrictions of Apple Pay and Google Pay. So whether we're about to see that happen elsewhere, I think will be really interesting to follow over the next few years.
And essentially, like in plain English, this essentially means you don't necessarily have to use, or you may not have to use Apple Pay to pay with your iPhone.
Yeah,
you could use something else.
Yeah, definitely. And I think that was the way that regulation was going anyway. There were some rules in the DMA, and also the EU's digital wallet regulation, IDAS 2, basically meant that every single provider would have to allow this mobile wallet that the EU is going to create, or EU ID, to be used on its system. So I think that is, it was definitely the way that the EU was going, but this really brings it forward. And it's interesting to see that Apple, but what I'm hearing, at least from Brussels, is that like a lot of people are surprised at how quickly Apple has actually bowed for pressure. Usually they do hold out on these things and try and push until the nth degree to make sure they don't have to comply. And it's interesting this time they have actually said, yeah, we will open this up now. So whether we see that happen in other jurisdictions as well, I think will be very interesting.
Very interesting indeed. Now, swiftly moving on to a few jurisdictions in the Middle East and Africa. Now, when I speak to clients, there's a few jurisdictions that tend to come up again and again about markets they're moving into. One of those is the UAE, and it's worth noting that on January the 1st, there were new AML regulations that came into effect in Dubai. So this includes amended suitability requirements for MLROs, sanction screening compliance requirements, among other things. So it's a sign, I think, of the regulation they're maturing somewhat. I think people have, maybe considered it before slightly less stringent than other jurisdictions on AML, but that seems to be changing. Also, interestingly, on actually January the 31st last week, any businesses that are supervised by the Central Bank of Nigeria now have to adhere to new KYC requirements and also revalidate all accounts and wallets. There have also been additional requirements aimed at consumer protection and transparency. Again, both signs that I think regulations are maturing in Nigeria. And I think Nigeria is one of those jurisdictions that's really setting the pace for payments regulation in general in the African continent. The other thing that caught my eye, there's anything regarding buy now, pay later regulations, always interesting because you've got this sort of myriad of maturity across the world. And actually on the 16th of January, the Saudi Central Bank released a raft of new rules for buy now, pay later companies that mandate that they have to adhere to the central bank's responsible lending principles. They have to comply with new AML, counter-terrorist financing regulations, advertising requirements, and more. So if you compare this to even, the UK, for example, where, people expected that to be one of the leaders in the regulations around buy now, pay later, it's interesting that Saudi have moved ahead of that. I've noticed there's a few Saudi companies, big ones, that are well funded there. So I wonder if it's the regulators responding to the growth in some of those companies.
Yeah, definitely. And the Middle East has definitely jumped ahead. I think Qatar and the UAE also introduced buy now, pay later rules relatively recently as well. Yeah. So it does seem to be that different jurisdictions are moving at different times. Like the UK, for example, has gone very quiet on consumer credit reform, which has surprised a lot of people. And I don't think that we're going to see any kind of reform happening for consumer credit agreements before the general election now later this year. So it's interesting to see that the Middle East has moved ahead there.
Absolutely. And now moving on to Asia. Now, I think there's one thing, particularly that you covered, Jimmy, this month that really stood out. And that was around Singapore banning non-bank remittance payments to China. What can you tell us about that?
Yeah, so I think this is really significant in a geopolitical context. The Monetary Authority of Singapore, the central bank and financial regulator in the country, issued a notice in December directing licensed payment service providers that provide cross-border money transfer services to suspend the use of non-bank and non-card channels when transmitting money to people in China. This rule came into effect on January 1st and will be in place until at least March 31st this year. It was triggered due to funds being frozen upon being received in China, which was having a negative impact, of course, on consumers. There are obviously a lot of expats who would be sending money back from Singapore to China as well, and they were being really caught up by that. The authorities have played down the prospect of this being related to money laundering as well, which I thought was quite interesting. So, it's to me, kind of looking in as an outsider to Singapore and China, I'm confused as to why this has happened. And I can imagine if you are a non-bank remittance provider operating in Singapore, that is incredibly stressful for you to have to comply with at the moment. I think all eyes on March 31st to see whether Monetary Authority of Singapore are able to basically allow these to happen again. I did see that the regulator did come out and say that they have spoken with officials in China and at the Chinese embassy in Singapore as well. But it remains to be seen what's going to happen there and how long this ban will stay in place for.
Yeah, it's it was a surprise to me for sure, and actually some people I spoke with didn't see that coming. Staying in the region, Hong Kong released two consultation papers last month. An interesting one was on the proposal to implement a regulatory regime for stablecoin issuers. I guess what's really interesting about this is that it's in line with Hong Kong's overhaul of its general crypto regulatory regime, starting with the release of its rules for crypto trading platforms in 2022. And I think given that the crypto market in China in general was obviously huge pre-crypto ban, this consultation, I think it represents an opportunity for firms wishing to take advantage of this sandbox to enter a stablecoin market in the region. So really interested to see how that plays out. The second one was again it's always an interesting topic. It's around the proposals to facilitate information sharing amongst authorized institutions. Now, obviously, the goal of this is to prevent fraud, financial crime, and improve AML outcomes. But of course, there's always the kind of data privacy elephant in the room. And I think that will play a big part in how far this gets. And, this theme isn't, of course, specific to Hong Kong. We're having these conversations all around the world. And I don't feel like anyone's found like quite a happy medium yet. It seems to go one way and then the other. And since we're on the subject of Asia, I know this didn't happen after the turn of the year. This happened in December, but I wanted to highlight it anyway because I thought it was particularly interesting that in December, China released a new set of regulations that impose a brand new licensing regime for non-bank payment operators in China, starting from May this year. So the regulation itself contains 60 clauses that regulate the licensing and supervision of non-bank payment institutions. These include things like minimum capital requirements, naming requirements, penalties for non-compliance, etc. I think the idea is that it's there to promote innovation and competitiveness in the Chinese fintech market. And it would also come with a new license type as well. So again, I think anyone that's considering entering China or already operating in China, that's something that you should absolutely be aware of. Wonder if there's any relation between those two things there, but then maybe not, who knows. And Anyway, moving on to North America. Now, I think there's been one kind of dominant story that's sort of been happening, not just in January, but we saw the responses to the Consumer Financial Protection Bureau's rulemaking on non-bank payment apps in January, and that's kind of stoked the fire in the conversation around this again.
Yeah, absolutely. The Computer and Communication Industry Association has, quite unsurprisingly, some could say, pushed back on new plans to regulate US big tech payment apps. And basically, they've said that the CFPB, which is not the most popular regulator with anyone really in the US, it's very interventionist. They're saying that they are looking for a problem to solve with this solution. And the CFPB, it's intending to introduce new rules that will define and regulate large participants in the market for general use digital consumer payment applications, which to me sounds like they are going to regulate it a bit closer than is currently the case. And if adopted, the proposal would apply to all non-bank consumer financials that handle at least 5 million transactions per year and would subject these firms to the same supervisory exam process as banks and credit unions. So this would be a pretty big deal. It's part of what I think, like sometimes I get the feeling that non-bank payment providers, obviously when they first came on the scene, really exciting and, they definitely offer innovation and good things for consumers. But I get the feeling that regulators the world over are now looking at ways to make sure that I don't know, often you hear in the EU, same risk, same rules. And I think maybe we're starting to see that a bit in the US as well. So yeah, it's going to be interesting to see what the CFPB decides to do in the end. And I suppose as well, there is that argument that actually these big tech companies that do provide payment apps, they are based in the US. And I think they probably do have a lot more leverage than maybe and a lot more rapport with the regulators than they do in the EU, where they're not necessarily the champions that they are in Silicon Valley. So it's going to be interesting to see how the CFPB goes forward with this after the consultation last year, and whether they do manage to bring out rules before the election in November, where I don't know, people I'm speaking to at the moment in the fintech industry expect that the CFPB is trying to rush quite a few things for at the moment because former President Trump, might be President Trump again, wasn't exactly the biggest fan of the CFPB or its current leader, Rohit Chopra.
Yeah, interesting. And I noticed as well, out of the sort of being led by the US, but also out of Europe, UK, Australia, and a few other places, there's a new raft of sanctions as well against Hamas. Yep. And I was at a roundtable discussion a couple of weeks ago, specifically on the topic of sanctions compliance. And I think the general consensus is, as we kind of trend towards this deglobalization, sanctions are only going to increase in frequency and probably complexity as well. Is there anything specific around the Hamas sanctions, Jimmy, from the US that kind of caught your attention?
So they have gone for two groups. These are the Islamic Revolutionary Guard Corps Quds Force, so IRGCQF, and basically to Hamas and Palestinian Islamic Jihad in Gaza. I think it's interesting. The US started with its sanctions regime for Hamas in October of this year, around the time that the conflict started with Israel. However, the other governments have now jumped on board as well. So, for example, I thought it was very interesting that the EU has coordinated with this one. So we're really seeing a lot of coordination between different allies in the West, these being the EU, the UK, US and Australia as well. So the UK and Australia did pretty much follow what the US had unveiled, but the EU has also introduced its own as well. And the latest round of sanctions targets networks of Hamas-affiliated financial exchanges in Gaza, their owners and associates, and in particular financial facilitators that have played key roles in fund transfers, including crypto asset transfers. So it's going to be interesting to see how well Hamas, the sanctions rather, perform. I think one of the big debates that there has been with the sanctions against Russia, for example, in Europe, is how effective authorities have been in freezing assets and actually, following or being able to deal with the sanctions. And I don't necessarily think that's actually, I think often it's payment service providers who are having to really quickly update their compliance and update their systems to be able to adapt. And I think it's more actually something on the authorities, how quickly they can speed up as well when it comes to these new rounds that are being brought out quite frequently as well, which wasn't necessarily the case before recent conflicts such as Ukraine and Russia and Hamas and Israel.
Absolutely. And whilst we're in the United States, at a state level, the only things I could really see that were notable this month in terms of things coming into effect, Indiana and Tennessee from the beginning of January both adopted the Model Money Transmission Modernization Act in full. So that's now even more states essentially harmonizing their licensing and operating requirements, reporting standards, supervisory enforcement, and legislative applicability with the Conference of State Bank Supervisors Model Act. So again, if you're a PSP fintech and you're looking at expanding across different states, entering that market, the idea of this is that it should make it somewhat less complicated for you. I think as 2024 moves on, we anticipate more states to adopt this act. So we'll be covering that closely on Horizon Scanning and journalistically as well. I also noticed that the Fed extended its comment period on lowering the cap on debit card interchange fees. I think given the impact this will have on issuers, networks, merchants, it's not a surprise that more time's needed to analyze the proposal and gather comments. And again, that's part of a wider trend. Maybe we're seeing in a few places where interchange fees are being capped as well.
Yeah. And I think on the US front with interchange fees, like whenever you speak to anyone from Europe, they are absolutely shocked by how high interchange fees actually can go in the US. So it's interesting. They have basically been consulting on this at the moment, and I'll be keen to see some of the responses to that.
Absolutely. And then finally, down to Latin America, South America. In Brazil, the central bank's public consultation on the regulation of the virtual assets closed on January the 31st. The consultation had 38 questions covering various aspects such as governance, money laundering prevention, risk management, cybersecurity. So any crypto asset providers, payments providers, even gambling operators. Gambling is a massive topic in Brazil at the moment. Any of those that have an interest in Brazil should be watching the outcome of this closely, because it's likely to have an impact across those three intermingled industries. In Chile, I noticed that the CMF has issued regulations for sort of generally financial services providers, including fintechs and PSPs. This creates a framework relating to the registration and authorization for the provision of financial services. These include things like obtaining authorization from the CMF, setting minimum capital requirements, making it mandatory for financial service providers, irrespective of the type of product or service offered, to implement these policies. There's also other things relating to cybersecurity as well. These regulations, they come into effect actually from February the 3rd. So what was that, yesterday? Any that are already in the market essentially have another year to update and comply with those. And finally, finishing up with current World Cup holders, Argentina, and some issuers, acquirers, and merchants operating in the country should note, and I think also welcome, is that the government has launched a new program called Quota Simple. Hopefully I pronounced that correctly. And this program is essentially designed to stimulate consumer spending in the country, which has obviously been greatly affected recently through an economic uncertainty and a sharp decline in the currency. Starting from February the 1st, essentially the program will offer financing options for purchases in either 3 or 6 installments with the lowest rate in the market provided through bank credit cards. So it's just interesting to see, almost like buy now, pay later consumer credit being used as a stimulus here, where it's greatly needed. I noticed we're almost out of time, so if you think there's anything that we haven't covered, you'll be absolutely right. Given the sheer volume of change we've seen in regulation across the global payments industry, it would be impossible for us to cram all of this into one session. And that's why the world's best compliance teams use Vixio's Horizon Scanning tool. So please feel free to get in touch with me or Jimmy or anyone in the team to learn more about that. Otherwise, Jimmy and I will see you back here in a month's time for February's regulatory roundup.
I think we should have some good announcements then as well.
Yeah, absolutely. Thanks, everyone.
Have a good day.